Well, when the Bank of Canada made its rate decision yesterday, it held rates at a 2001 high at around 5%. There was a lot of discussion about the housing market. The bank made it clear it's watching those mortgage renewals and the extent to which it pressures consumers at the same time that they acknowledge that there are structural issues in the housing market, like a shortage of supply, that are keeping things elevated. To help unpack this, we've got Sam LaBell still on the desk with us, and Sheila Copps, former Deputy Prime Minister of Canada, joining us now. There is the monetary policy that's trying to exert pressure on the housing side, and then finally there seems to be policy efforts to try and increase things on the supply side. Sheila, how do you think about those efforts and when they might start to be meaningful?
Well, most of the supply side efforts are going to take time. Obviously, even from the point of offering a fiscal advantage for new builds, the announcement that the government made a couple of months ago, that's not going to come to fruition for at least 9 months to a year. You are seeing an uptake in some of the young people who are deciding to do a first-time home buyer, etc. But all of these measures take time, and unfortunately, the current government doesn't have a lot of time. They're in a minority situation. The Conservatives would love to have an election ASAP on this issue. And so it's rather tricky on the political scene for sure.
Well, and at the same time that, supply would be welcome reprieve, there were some pretty pointed comments by Bank of Canada Governor Tiff Macklem about fiscal spending in general and what it is doing to inflation, calling it not helpful, but at the same time understanding that, people are looking for help, they're looking for relief. Do you think that the message of you need to help Canadians, but you can't add to the problem, stoking inflation further, is resonating right now?
Well, I think the governor of the Bank of Canada is telling politicians not to be political, and he's being a little bit political. You saw the message that he gave to premiers, basically saying sort of stay out of the business of the Bank of Canada because you're going to hurt the economy. We have an opposition leader in the federal government who wants to get rid of the Bank of Canada. So obviously it's a political issue. And when people are hurting as they are with mortgage renewals, with underhousing, with the cost of food inflation, it's a very fine line that Mr. Macklem is treading, and I think when he gets into the issue of assistance for people, it's a political decision. It's not his decision.
Certainly, Pierre Poilievre has been critical of the head of the Bank of Canada. I don't know that he's advocated for the abolishment of the organization in general.
Yes, you're right. He's called for the getting rid of the head, but he's also called for a Canada that runs on cryptocurrency. So I'm assuming if you're running on cryptocurrency, you're probably not having an organized Bank of Canada.
Sam, you think a lot about the risks that the housing market poses to the Canadian economy. Maybe not today, but there is a pending cliff, perhaps, with Canadians having to renew in a few years' time at much higher rates, if indeed we remain higher for longer.
Yeah, one of the things we look at is the debt service ratio. So this is the percentage of your disposable income that is going towards housing, towards your debt, to servicing the debt. And that ratio has climbed up to kind of 2007 levels, very high. And that just signals that the consumer is under a lot of strain. However, people are saving more. The savings rate has crept up above 5% of disposable income, versus about 2.2 before in the 5 years prior to the pandemic. So people are saving, they're getting ready for these debts, but what that does is just slow the ability to spend in the economy. I would say on the fiscal side, we talked about the fiscal side. In Canada, we have actually quite a bit better fiscal situation. As much as we look at the infighting here between federal and provincial, I'd rather have our infighting than some of the infighting we're seeing in the States. But our fiscal situation isn't as dire. We're not running. If you combine both levels of government, you're talking about less than 3% of GDP in terms of deficits. So we do have an opportunity here. We put our pension plan, the CPP, on a better footing by having it invested. We've done an actuarial reassessment of OAS. So all of these programs that we think are going to pressure spending going forward are actually on a lot better footing than in the U.S. The U.S. Treasury Department did a study on their deficit for Medicare and Social Security, and it's something like 4.3% of GDP for the next 30 years. So they're either going to have to find a way to claw back benefits, reduce or increase taxes to pay for that. So this is part of why interest rates are going up. It's not just inflation. It's also we're taking a look at what are the demographics going forward? What kind of spending do we need to support? How much does government have to outlay? And that can put a lot of pressure on the bonds. If the government tries to sell a lot of bonds, obviously it needs to find buyers at higher rates. So.
And Sheila, that message, the divergence, or I guess the reduced extent to which the Canadian government is spending relative to the U.S., do you feel like that's being effectively communicated?
No, I don't. But in any case, most Canadians are busy living their lives and they're not looking at debt to GDP ratios or specific economic factors, but they're hurting. And I think they expect politicians to provide answers. And some of those answers are not as easy as we would expect. You can't just all of a sudden turn on a tap and find housing. There are measures that are being taken, and some may last, some may not last. The decision by, I think, the government of Vancouver to get rid of Airbnbs is supposed to open up a bunch of housing. We'll see if it does. We're not sure. They did the same thing in New York last week. So there are some other measures as well. But there's no doubt that on the fiscal side, the government has to show Canadians that what it is spending is there to help them and not simply bloating the deficit.
Sheila, thank you so much, as always, for your perspective. That's Sheila Copps, former Deputy Prime Minister of Canada, joining us, talking about the policy side of things and putting this into practice, Sam, because you are sort of cautious about housing, what this could mean for Canadians. You've been short the Canadian banks, most of them, I think, except National.
Yep.
A great trade because they're most sitting at a 52-week low, and a lot of people caution you shouldn't short them because of the dividend yield, but you've certainly been able to compensate that with the negative returns. Are you at a point where you want to say enough is enough? I can close up my short?
So with the Canadian banks, they typically bottom when the provisions for credit losses kind of reach their peak because all the damage has been done. Banks have to take provisions before the actual damage is done. So once they see that people are maybe late on a payment, they have to, it's all staged. There's 3 stages under IFRS, and they have to do it in advance. And when they first book it, they book it at a very low rate. But then if you miss a payment, then they move it up to a higher rate. And then if you tell them, oh, I can't pay, then they move it to the very highest rate. So there's this whole process that filters through before the actual default even happens. So it's a bit of a leading indicator of the pain. And so when those peak, then it's usually the pain is already built into the earnings, have been poor.
So have they peaked?
We think that there's probably another 3 to 6 months. Just talking about how much of the book is actually rolling over. About a fifth this year, a fifth next year, a fifth the following year of mortgages rolling over to higher rates, and those rate hikes could be 25%. So it's a big amount, and again, that's without considering the second order effect. If there's a huge slowing of the economy, you've got unemployment, then you've got people potentially even in worse conditions. So we just think it's a risk off for the banks right now. And if they have to compete on yield as well. So it's the same question. If your earnings aren't growing at 5-6%, I'm not going to take a 3% yield, 4% yield from the stock.
Okay.